When is the US housing market going to crash? Well, there's two possible scenarios that could possibly cause that to happen. But even with housing affordability at an all-time low, an increase in the number of listings available on the market, and a slide in real estate sales, housing prices continue to set records, increasing 4.8% last month, and luxury housing hitting an all-time high. So while it seems that the stage is set for a housing crash of epic proportions, well, the question is it actually going to happen, and when will it happen? But before I get into all the details, my name's Nolan Matthias, and if you want to thrive financially, this is a place for you. So do me a favor, hit the subscribe button and hit the like button so more people like you can see this video, and turn on the notification bell if you'd like to see more videos on the US housing market and global macroeconomic conditions. Okay, so let's jump into this. And if you're new here, one of the things that we like to do on this channel is go through the news, the headlines, and see exactly what's going on. And then at the end, talk about the things that could potentially affect you, like a housing market crash and how you can predict when that is actually going to happen. And like I said in the intro, there's basically two ways that the housing market could crash. And one of them's quite obvious and the other one not so much. So I want to start by showing you the headlines because it seems that every single day we're seeing a new YouTube video, a new article, a new blog about the US housing market and when it's going to crash, almost as if it is an inevitability. And I mean, there's no surprise here. With affordability where it's at, you would think that essentially something has to give. With interest rates going up, you would think something has to give. I mean, there's all these things in the economy that would make you think that something has to give, but nothing is giving. Home prices continue to go up. And the real question isn't how much will they go up, but for how long will they go up? And I think I've got some insights about that at the end of the video, so make sure you watch till the end. And not only are we seeing a ton of content around a market crash, but a lot of content around when houses will once again become affordable. And while housing affordability is definitely a problem, it seems that it's not a problem for some, because luxury real estate prices just hit an all-time record. According to a new report from Redfin, the median priced US luxury home sold for a record of $1.225 million in the first quarter of 2024. That is up 8.7% from a year earlier. Now, what I find interesting about this is that luxury real estate sales and the median price for luxury homes is up substantially more than what the median price is for the entire market. For the market as a whole, the median price has increased by about 4.8% compared to last year. But going back to this report, the one thing you need to understand about the median home price is that this is not an average price. The median home price is the property that falls in the middle of all of the luxury sales. So what this means and what it implies is that the lower end of the luxury real estate market is probably the part of the luxury real estate market that is actually moving. And to me, there isn't really a surprise here because properties that are priced around that $1 million, $1.25 million range are properties that households that have maybe two professionals in them can typically afford. So as inflation increases and as wages increase, it's no surprise that the lower end of the luxury market is being pushed up. And what's even more telling here is the fact that we're seeing luxury sales increase while non-luxury sales decline. And there's a high likelihood that this is directly the result of people moving from the non-luxury market into the luxury market. So in other words, the people that would have typically bought at the high end of the non-luxury market are now the buyers in the luxury market. And what we're seeing is just a slight shift in where the buying activity is, where there isn't really an adjustment in what qualifies as a luxury home. So as borrowers in general are making more money due to wage inflation, they're moving up in the property scale, and this is skewing those numbers in favor of luxury homes. Now, to be clear here, the properties defined as luxury homes in this report are the homes that are deemed to be in the top 5% of homes in the given communities. And as you can see, according to the same report, the availability of these luxury homes has increased. But as the availability increases, so the number of listings increases, you would expect the prices to actually come down. However, that isn't the case. There's an increase in supply and an increase in prices. But this is where it gets interesting because when you start looking at the overall market, you can start to see similar trends in what is happening. For example, the median price in the US has now gone up to $420,357, which is up 4.8% from last year. Now, this is even while the number of homes sold has gone down. And you would think that with the number of homes being sold going down, you would see prices coming down. But the reality is that the number of listings that are available is still low, especially in historic terms. And the reason for that is what we call the lock in effect. This is where we have a large percentage of homeowners who bought in the last several years who have extremely low mortgage rates. And were they to sell, they would give up those historically low interest rates in order to purchase a property at a significantly higher interest rate. So, as a result, we're seeing less properties come available on the market, which means even though there's fewer sales, we're seeing increases in prices because the competition for the available homes is still quite high. And even though the months of supply is running pretty similar to what it has for the last 5 years, it's still at a level where you are in very much a seller's market. And what defines a seller's market? Well, that is typically when there's anything less than 3 months of supply available. Less than 3 months of supply available on the market is considered to be in the seller's favor because there are less options for buyers to buy. And as you can see, there is momentum growing in the spring market in the US right now as we start to see the months of supply start to come down. And that is usually an indication that there are certain markets where there are bidding wars, and that is going to lead certain homes to sell for, well, more than what they're listed for. In fact, if you take a look at the number of homes that are sold for above list price, it is 30% of homes. That is a significant number of homes being sold for well over the list price. And to put this in perspective, when you go back and look at prior to the pandemic, which would have been the most normal real estate market we've seen, at least in the last 5 years, you can see that very rarely did we get all the way up to 30% of homes being sold over list. In fact, it typically runs around the 20 to 25% range. So to see this number be this high, even when people are predicting that the market must crash, well, that gives us a pretty good indication that we still have a supply and demand imbalance. So, in other words, there's more demand than there is supply, which is causing houses to sell for more than what they're actually worth, or at least what they're listed for. And this is where, in my mind, things get interesting because if you look at the migration trends, you can see that there are a lot of states that people are moving away from. Take a look at California, for example, Washington, Oregon, New York, very much states that have high tax levels and what is very much a standard of living that is being reduced on a regular basis. And then if you take a look at the places where people are moving to, places like Arizona, places like Texas, places like Florida, and the Carolinas, and you can see that there's definitely a transition happening towards places that have lower taxes and therefore have greater levels of affordability, not just in housing, but also in pretty much everything else. And let's call a spade here. When everything else has gotten so expensive due to inflation, it is not surprising that people are looking to other states with a lower tax base and a lower cost of living when it comes to the non real estate stuff in order to be able to afford the real estate stuff. So, California, for example, would be a prime example and is the prime example of where people are leaving because of the fact that not only has inflation reared its ugly head there, but housing costs have gone up, so too have taxes, and it has pretty much become unbearable to actually live there unless you have a significant amount of excess cash flow, which for the majority of people is just simply not the case. And here's the thing, with the clear supply and demand issue, with the increase in luxury prices, with the increase in regular home prices, it's pretty clear that we probably aren't going to see a housing crash in the near future, especially if the Fed actually follows through and reduces interest rates. And that leads us to these two circumstances that could cause the US real estate market to crash. And I'm going to start with the one that you probably wouldn't expect, and that is the unexpected surprises that nobody expects. The things like the housing crash in 2008 that pretty much blindsided most of America. So the one thing that could potentially cause a US real estate crash is something that nobody expects. But barring an unexpected event, there's only one other thing that would probably cause a real estate crash, and that's a recession. And I can tell you right now that the fact that the Fed has changed its mind with respect to its course on lowering interest rates is a pretty good indication that we are not heading for a recession. And not only that, but the Federal Reserve and other central banks all over the world have actually gotten better at reducing the number of recessions that happen, reducing their severity, and increasing the length between recessions. And if you take a look at the last 50 years, what you will notice is that there's typically an 8 to 10 year period between recessions, with the most recent one being in 2020. Now, that's not to say that another recession won't happen sooner than what is expected, but when it comes to US housing and a US housing crash, barring unforeseen circumstances, something that nobody expects, the reality is that the next correction, the next big correction to US real estate will happen and coincide with the next recession, if it happens at all. And that is because in order for there to be a massive correction in the US housing market, there's going to need to be a perfect storm of insolvencies, foreclosures, and, well, unemployment. And if the majority of citizens are remaining gainfully employed and they are able to continue to be able to pay for their homes by scraping together whatever dollars they need to, well, there's actually a better chance that wages will catch the higher cost of living than there is that there will be a major market correction. So, if you are thinking about jumping into the real estate market and you're waiting for the housing crash to happen, there's a good chance that you will be waiting a long, long time. And in all likelihood, if real estate prices continue to go up, it's probably better for you to get into the market now, albeit in a property that is very much affordable for you. Don't buy at the limits of what you can afford so that you are in the market in the event that prices continue to go up and you don't end up waiting 5, 10, 15 years and getting completely priced out. So I would very much expect that the housing prices and the market, the way that it is right now with a lack of supply, is very much the new normal. And when you're doing your planning with respect to buying a home, I would look at what is happening now, and then I would look at the best case scenario and the worst case scenario, and then make your decisions based on that. And if you purchase a property that is affordable for you, so in other words, one where the costs don't exceed about 25% of your income, well, you'll probably be well positioned to withstand any sort of recession, any sort of crash, and have a property that is building you equity while you wait for that inevitable crash. And by the way, when the inevitable crash happens, that is your opportunity to move up to a nicer home using the equity that you've built while you were waiting for that crash to happen. Oh, and I talked about the fact that the Fed might be canceling rate cuts. Well, if you want to know more about that, make sure you check out this video right here.